Hey everyone, John Henry here, slingshotfutures.com. Today we're going to be talking about surprise moves in the markets. Now, the markets, there's always a surprise move here or there or somewhere, and generally speaking, really what we're talking about is something that took the low probability route. Whenever I'm talking about trading as a whole, a market has, well, three different types of probabilities in my opinion. The first one is just flat 50-50. You don't know. Flip a coin, you've got just as good of a chance. The other option is either a 40% or a 60%. And the market tends to range in terms of probability within that band, between 40 and 60%. Sometimes it deviates outside of it. Sometimes it deviates, above that. But generally speaking, the market operates in a band of 40 to 60% probabilities. And what I'm talking about is when you have a higher probability opportunity, like a nice short opportunity or a nice long opportunity that begins setting up, and it's a really good one, 65-70% likelihood that you're going to be successful in the trade, and it doesn't work and does the opposite. That's the type of situation that I'm talking about. And when I'm looking at this type of situation here, the S&P and the indexes as a whole had a great example of this today, where we started off, right? This is yesterday's close right there. And with yesterday's close right inside of there, let me get that at the right place, there we go. We're opening up with a small gap down, right? So the first print of the day is right there, small gap down, and that's originally, right off the gate, after yesterday's whip back and forth and the fact that we're right at the top of a potential structural area of interest, it makes a lot of sense that the market will find some sellers who are trying to drive the market lower. And we can see that reflected in price, right? We have a small gap down, it opens up, catches a lift higher, and then pushes down with a beautiful bear bar. Sellers will be underneath that bear bar looking for continuation lower. And what do we end up getting? We end up getting that continuation, right? Beautiful move to the downside. So they were correct. Sellers were correct in assuming that the market was going to roll over and catch a drive to the downside. But then this happened. We had some news with Kavanaugh and a bunch of other stuff, so there was a news impact on this. But we had a strong spike against that move down. And a lot of sellers probably took the short, but didn't exit everything. They partial out, take 80% of the position off, something like that. And we wind up with a situation where this happens. All of a sudden, the trade was beautifully bullish, or bearish rather, and way in their favor. They're deep in the green, and then just like that, it's all gone. And that surprise move has now taken back a good 65-70% probability and flipped it and took the 30% option instead, and it went flying higher. So because of that, this is a surprise move. Now, when I'm talking about surprise moves, very frequently you're going to have a lot of market participants that are stuck on the wrong side of it. That's really where this gets even stronger. So now that we know that a lot of sellers are stuck, they're going to be looking for the market to roll back over so they can, maybe get out of break even in the last portion or take a smaller loss on that last bit than they really need to. So what do we get? Well, we know sellers were here and we have a surprise move up. So what are we going to have? Well, there are probably going to be more sellers underneath this bear bar that try to get the drive down and exit everything at their original entry point. It's a very common practice of exiting after you've built into a position, exiting everything at the final entry point that you had. In this case, it doesn't make it, right? So we know that sellers are short from here. We have another opportunity right here, and all it does is go to the break-even point, and the break-even point being the distance between the two, 50% of that, right? That would be the halfway point. That's break-even. And that's exactly where the market bounced. Now, if you were trying to get out of break even, perfect. That's exactly what you needed to have happen. And actually, because you might have already exited some, that would still be a winning trade. But that is going to cause a little bit of concern because when you have a surprise move, right? A surprise move almost always comes with two legs. Now, the reason there's two legs is because you have the first impulse move, right? So we have a short opportunity right here, right? Actually, I'm just going to use lines. So we have a nice shorting opportunity right there. It drives down, but it fails to continue and pops up and really takes you by surprise. This right here, this is the impulse leg right there, right? That's the one that took everybody by surprise. So because we have an impulse leg that took everybody by surprise, we're going to have new trade management coming in, people trying to drive the market down so they can get out of break even. Maybe sellers still believe that this is a fake out to the highs and it's going to go down. Regardless of the case, there are going to be sellers here who are going to try to drive the market down for a break even test or potentially a push back down to their final entry point. And if that doesn't happen, this is their chance to get out. And if it doesn't hit it by that point, it's going to go back up for a second leg, almost always. And that's because everybody is exiting along the way here, right? They sold here, they sold more there, people are getting out at break even. You have sellers who sold here who are taking profit. everybody is starting to exit in the same location. That causes that second leg up. So you have the impulse leg up, and then you have the follow-through leg where everybody starts jumping on board. The sellers start exiting, buyers start coming in, pushing the market, etc. And you run into a situation that allows another leg higher, and that's exactly what we had here. We have that first impulse leg, sellers coming in to try to drive the market down, taking profit, exiting, XYZ, whatever it is, and then we have the secondary leg up. Now, this is even more the case when you find an area that really, really trapped somebody. Something like over here, right? This is a really great example of it because we have a bull bar trigger, we have two legs to the upside, and we have support coming in the form of a channel low. Buyers will be buying into the low of this, assuming that we're going to get another leg up. And it doesn't, right? So what happens? Well, buyers are trapped from this point. And this is where you can really start paying attention to the bigger picture and what's going on, because you can track these entry areas, right? 289.47 rather. The market continues to fall down a little bit farther, and we're looking at other potential entry points now that line up, right? That give them a reason to potentially exit, right? Gives us a break-even point, etc. So we have the first entry at 289.47, the second one at 289.10, and we'll just keep going down until we find what happens, right? So we'll keep going down here. That one never triggered. This one triggered. So we have another long that triggered right there. That was at 288.39. Keeps going down. We have another long that triggered right here. This one is too close. Nobody's ever going to really buy that. Doesn't make any sense. We have another long that triggered there. Every bull bar, right? You have another long that triggered here. And you have another long that triggered here. Now, these are all very important areas of interest because what do we want to figure out? Well, we want to figure out where their average is. If somebody's piecing into a move like that and they're obviously wrong, their likelihood of being able to try to make money on the trade is not very high. Their goal instead is to mitigate loss. And because of that, we know that they're probably going to be trying to exit at break even, maybe break even a little bit, right? Put some icing on the pancake. So 289.46, 289.10, 288.39, 287.40, 287.13, 286.70, 286.48. Now we divide those all by how many entries there were, which were 7. 1, 2, 3, 4, 5, 6, 7. And that gives us an average price of 287, we'll say 81 to round up since they're trying to get out of break even plus a little bit. So 287.81. Let's get rid of all these other things. 287.81. And we'll just edit this one. 287.81. We're going to make that really thick so we know that is the break even point, right? Now, if you're looking at that line that I already drew, you'll notice something that happened at that area. What happened, right? Well, what happened was the market came up to it and immediately started rejecting it. And why would that happen? Well, everybody's starting to exit at break even. They're trying to get a little bit above it and then takes them off. Get a little bit above it, takes them off. Get a little bit above it, takes them off until they're finally completely flat. And then what happens when all of those buyers that were trying to prop the market up are gone? It rolls back over and dumps back down to the lows because it's offered them a way to get out of break even. And if buyers are getting out of break even, what does that mean? The buyers are gone, right? The buyers are leaving. They're turning into sellers, and that creates an artificial short-term area of resistance, which rolls the market back over for that second leg down. That's exactly what we were talking about. This move down took everybody by surprise. They scale in, they build into their position to exit out at break even and potentially even reverse short, and you get the second leg to the downside that they were able to make more than enough capital gains on for the move down. Perfect example of what a surprise move looks like and something that you really want to keep in mind. If you're in a situation where you were in a position, and you may not be scaling in, scaling out like that, that part might not be relevant to you, but the part that is relevant is the fact that it is still occurring. With or without you, doesn't matter. It's still happening. And understanding what's happening at these specific price points and why the market is responding the way it is to these price points is where the mindset of psychological trading comes in. You know what's happening, you know why it's happening. Now you can create a situation where you can trade off of it, right? This might have been a beautiful selling opportunity inside of here that would have offered up a low risk, right? Breaks down, gaps down, pops back up, starts turning lower, can enter in with a short move towards the downside breakdown with a stop just above the highs. You offered yourself up a beautiful 2-to-1 plus, actually went about 3-to-1 to the downside by knowing what's going on in these areas. That's why it's so important to, even though you may not be trading that way, to understand where these locations are. So hopefully you found it useful, hopefully you found it interesting, something you can add to your tool belt, and definitely something you want to keep an eye on in the future. Yeah, and outside of that, if you have any questions about it, because it is a relatively thick topic, feel free to post them down in the comments. Shoot me an email, jbrink@slingshotfutures.com. Either way, we can go over it a little bit more in depth for you. Regardless, that's going to do it for this one, so I hope you enjoyed it. If you did, make sure to go underneath the video, click on that little thumbs up button, throw us a like on the video, subscribe to the channel so that you're notified every time one of these videos comes out, and click the notification bell icon to the right of that so it tells you when those videos come out so you don't miss anything important. Enjoy the rest of the day. Hope you had a fantastic trading day today, and we'll see you all in the next one. Thanks.